Oh, good evening. Just wait for some people to drop in. Two seconds while I just get other people to drop in. How we doing, guys? How we doing? Just gonna wait a couple of minutes before we get a couple more people in here, and we'll get started with the Darwin review today. Again, you'll have me. Kieran's actually busy down in London, so I'll be taking this session today. How's everyone's trading been today? I can see we've got quite a decent move on silver again today. Volatility seems to be picking up yet again. ATR level moving higher and higher. So be interesting to see, will this break down into like these psychological levels of 70, 60, and 50? Good evening. Good evening. How we doing? So yeah, it'll be interesting to see what happens tomorrow, especially when we've got some news overnight as well. So it could be quite interesting to see what happens. Again, we're seeing big moves down on like the indices again. So yeah, I guess we'll just have to kind of see. Just for context, like obviously I'm an algorithmic trader, so it sounds quite bad, but I don't really care where the market goes. I'll just trade whatever direction it goes in. So I don't tend to look at the markets too much in terms of these sort of things, but interesting to see. It's a market full of red today, not much in the green. Yeah, unfortunately, I'm currently in a short in dollar yen, and it's not looking too good. And I think I'm long Aussie yen at the moment. So yeah, we'll see how that goes. It'll be good to see how they play out, but it is what it is. Let me try get so yeah, for those that don't know, I'm the person that's behind IME, and this is my Darwin here. Does anybody want me to go over their Darwin today? We can have a look at it. Because it'd be quite interesting to dig into some of the stats. So if you look at mine as such, I'm mainly Forex as well as commodities. So, I trade a variety of things. And, I trade quite a lot, but different sessions as well. So one thing that I've been looking at, and I think this is quite important, like to look at like the distribution of the days of the week. Tuesday has been terrible for me, like slightly positive, but pretty much all my returns come from Monday and Thursday, which is today. So one thing that I've been doing lately is digging into some of my strategies to see how are Tuesday, how are Friday, and see if I can sort of amend it and get better results as time goes on. Because yeah, most of my things come in Tuesday, Monday, and Thursday. Wednesday's not too bad. Friday could be better. Tuesday's terrible. So I'll be going through that over the days. Interested to see how everyone is getting on DarwinIA today as well. So what we got in gold today? So wow, 7% already for the month. Let's dig into this person. Okay, interesting sort of return. Good return to drawdown. Investment's kind of erratic, but let's have a look at the results. Yeah, results are pretty stable. Had a horrible January, but recovering well in February, which is good. Yeah, see a peak drawdown there, so interesting. Let's see what these trade. So S&P, gold, NASDAQ, Yeah, quite a variety. This is quite good in terms of diversification. You know, it's good. It's good. I always find with being an algorithmic trader, like I have my like main sort of like markets that I trade, but I always want to get more in. The question is it worth it? So let's dig into this person. See, so 53 trades on Euro New Zealand 0.69, still positive Aussie CAD. So yeah, this is looking pretty stable from a diversity point of view. Interesting to see how everything going. So European session is where European and Asian session is where the brunt of it's coming from. See, this is an interesting statistic that I'd be looking at here, and this is why it's good to sort of like review these areas. So we can see that American session, he's had 1,287 trades and a minus 2.43. So, you know, if I was to be looking at that, I would then be going back to my strategies, potentially going in Quant Analyzer. If I can get Quant Analyzer up. So on the other screen, 2.6. Let's see if I can get this across. Right, what have I got here? Yeah, so these are just two of the strategies I've been working on today. Get a just in case there are questions. So yeah, what I would be doing is we can see specifically for that person, it's like the American session. So this is a good thing about Quant Analyzer. We can look into profit per hour, month, and day. And just for FYI, this is a long only strategy of GJ. It's pretty good, and it just doesn't trade around the close. But you know, this isn't a good example, but what I'd be doing is looking at this area and categorizing it as it does on Darwinex. This is the beauty about how Darwinex tells you how it categorizes each session. So you can go back and really have a look at, okay, let's look at this trading strategy, import it in HTML file, and let's analyze it. Which, if nobody knows, link your account up to MyFXbook. And if you're an algorithmic trader, it's a lot easier. Because you can assign magic numbers, and on MyFXbook, you can actually search report by magic number, and you can extract the report into HTML file that then you can put it into Quant Analyzer. So you can actually analyze your real time sort of like analytics of that strategy. So you could clearly see that certain, like maybe if you've got like 10 strategies and you're losing in the like Asian session, or sorry, the American session, you could extract them one by one, and then you could pinpoint to know exactly which strategy is really killing you around that sort of American market. And then you can go back and potentially like build around it. So you can say, okay, it's clear over the past, so this Darwin was like just over 2 years. It's clear over the past 2 years, it's struggling to make profit in that session. Let's go back and take that and test it across, say, like an extra 5-year period, and let's just look at how it performs around the American session. So I would put like a time filter in that's only trading around the American session and analyze it from there. And you'd be surprised how many strategies that, like, when I first started doing algorithmic trading, like, I would just be like, all right, okay, I'm going to trade every hour of every day just to be as robust as possible, because I want to capture, I just want to be in all the trades. And as well as it's good, it means you capture everything, but there's a lot that you're giving back to the market that could be avoided. And when I say like robustness, what I mean is we are really digesting it into like categories. So like for me, June and July here, I don't really play around with months too much, but you could remove June and July and always not trade June and July. I mean, this is obviously, the data is obviously showing from 2018 right up to the end of 2015 that June and July, the strategy is terrible. Well, it's not terrible, but it's not like the rest of the months. So what I would do is, this would be quite interesting test. So we're going to actually dive into this and see, is it just a one-off year or is it consistent? Because if it's consistent down year on year in June and July, then this is a change that I would potentially make to the strategy without, because I wouldn't say it's over optimized because it's consistent. It's consistently performing poor in June and July. Is there logic behind it? Yeah, potentially, like people will be away on holidays, so the market's less volatile. So as long as you can kind of back up or validate it, I would then sort of like, yeah, that's fine. Hours are different. So again, categorizing it into sessions, Asian, London, and New York. Like if you've got a consistent like New York session, like that person, and it's not performing well, then you don't need to trade that, because you can be consistently trading the Asian and the London sessions. So as long as you're being consistent and not like, for instance, looking at this report, we're not traded at 0 hours, we're not traded at 2 in the morning, we're not traded at 4, we're not traded at 1, we're not traded at 3. Like that is over optimizing. And that's something that I would completely avoid. So as long as you like categorize it, it would be good. So let's actually have a look at June and July on this. Select all, unselect June and July. So this is on Quant Analyzer, and it's in the what if. So you can create the scenario that it'll trade Monday to Friday, Saturday, but not Saturday, Sunday, because it's obviously currency is all hours, and we're going to only look at June and July. Press create, and this is what we get. Okay, so this is just June and July, and it seems to me that it was kind of break even, dancing around until 2022. Yeah, 1, 2, 3, 4, 5. We've only had 3 positive years. Yeah. I'll analyze your one after this one. Be quite interested to dig into someone's life because I've never done it before. But yeah, we can see that this is potentially. Is there enough trades? 90 trades. 90 trades over 2 months, over 1, 2, 3, 4, 5, 6, 7, 8, 9 years. 9 years, 2 months. Is it enough trades? This would be borderline. I would need to check it across like other sort of strategies that I trade on GJ to kind of validate it. But this would definitely be potentially, I would stop trading June and July on this strategy. Because like I trade like a multi-strat portfolio, missing June and July, even if it has one big year, the rest is evident that it's not good. So if we take June and July out, let's see how this changes, because the strategy's already got a 1.5 profit factor. So if we select all, take June and July out, we've dropped the drawdown, we've increased profit factor, increased win rate, we've lost 90 trades. So yeah, this is now getting to something that is seriously good. 0.78% drawdown with 1.28% return. Again, we're seeing like it's pretty consistently. The single hours, don't worry about that. The days, it's very strong. Friday's the weakest day. I'm not going to change anything like that because I've already optimized 2 months. So I'm not going to keep over optimizing unless it's clear that Friday is not good enough to trade. But yeah, that's essentially what I would do to find sort of like filter it out and maybe look at like how to deal with sessions that are poor. Like I'm going to be looking at mine, especially because obviously it's a Thursday that's terrible. But yeah, we'll go check your Darwin. AJBY. Okay, this is yeah, man, this is seriously impressive. Congratulations. 21.6% with a minus 5.01% drawdown is brilliant. That is great risk to reward. So congratulations on that. Yeah, profit per month every month since September. Yeah, well in. that is pretty impressive. Please keep it clearer. I don't know. Apologies, this is like my second time live streaming on this, so I will make it better the next couple of times. I don't know how I can actually make the stream better. Let me just have a little check on the sort of settings, and then we'll get back into this. High definition. Sorry. Yeah, it was on the VPS. That was on my VPS, so that's probably why the thing wasn't as clear. Do you think I can get gold in 2 months? Because I need 8 months of data. 8 months data to make Darwin. 1, 2, 3, 4, 5, 6. Let's have a look. So based on the criteria, you will be in gold after 8 months. Because right now your return to drawdown is 4.3 and your return is over 20. So as long as that return stays over 20 and your drawdown doesn't change, you will be in gold in 2 months' time. And hopefully that'll get you open to investors, and who knows what can happen. Things can happen quite quick, you'd be surprised. But I'm just going to have a quick look at your best and worst days, because I always like looking at best and worst days, because this tells me like how much risk is really or how many trades you really have open at a singular time. So yeah, this is very minimal. Thank you very much. Any advice for me? We can dig into the statistics and have a look, but so far, like, I wouldn't change anything. It's clear that you're doing things right. You know, the return to drawdown is great. All profitable months. One thing that I would say is when you do, everyone will have a negative month. Just keep a clear head. It happens, and just continue doing what you were doing. Don't change anything unless you're knowing you're doing something wrong, or there's a clear indication that something is not right. But right now, worst days against best days. This is very good. You've got more better days than you do worst days in terms of returns. Yes, your 2 worst days out with that, but overall, this is really good. Same with weeks. I'm Algo Trader, 4 bots in. Yeah, brilliant. That's good stuff. How much are you risking per trade? Because we'll go into the D, right? The D, whatever it's called. I always get muddled up with names because I call them things myself. All right, digging into assets of yours, right? Interesting. So this is quite interesting because, like, for the time that you've been on it, like, you've not taken heaps of trades, which is not a bad thing. Win rate's quite high, which is good. Gold again, gold is absolutely crushing it. So if you've got an algo that's trading gold to the long side, you're doing great. Like 2% max per day, 4 bots combined single. Yeah, that's fine. Because obviously, like, as long as you keep your risk consistent, it's the VAR system will be able to make a good estimate in terms of your Darwin multiplier. The worst thing you can do is start playing around with risk, because that will change your multiplier. Sometimes, again, it'll be the flip of the coin. Sometimes it'll be for the better, sometimes it'll be for the worse. So if you are going to make changes, like if you were to add more bots, I would slowly reduce the risk potentially. It just depends, because again, this comes down to personal preference and how people build portfolios. The reason that I risk 0.1 is because if I add in a new strategy, it's not going to change my risk multiplier. It's not going to impact my max drawdown. Where 2%, if you're risking in a singular trade 2%, and then you add another bot 2%, then that could change. But yeah, if your plan's just to stick with a 4, then don't change anything. That's what I would say. When you're wanting to add more things in, that's where it does get a little bit more trickier. But again, everything just gradual. If you make sudden changes like that, it's not. I personally don't think it'll end well. But yeah, keep doing what you're doing, because this is great. Trading euro dollar, and gold. Like, one bot can lose 1%, but others can win 0.15. So that'll be an out of day, but not too much. Yeah, that's fine. That's fine. But yeah, that's not too bad. As long as you keep your risk consistent, I wouldn't be too worried. Again, looking at your time distribution, European session highest, then Asia, then America, but results are pretty good, consistent. Obviously, European sessions being the bigger one, but even your Asian session, like, you took half the trades and you've got about a decent result. So I wouldn't even looking at that. Again, this is where we can dive into this, but because I would say you've got an insignificant amount of trades to say really don't trade Monday. So as much as you'll see that Monday's negative, you've only been on it 6 months. I don't think 6 months is enough time to make a calculated decision into getting rid of trading Monday or having a deep dive into Monday. Maybe have a look at your back test on Monday and have a look. That's the only thing I would suggest in this scenario. But just because the metric here just says Monday's negative, I wouldn't change it. Go back, look at your data. Your data will tell you. And if your data doesn't line up with, so like this is what I do. From the moment I turned on the systems live, I have a back test that has everything in it. Then when I turn it on, I then like compare them. So like Monday is it profitable, Tuesday, Thursday, Friday. If they're all profitable, I'll trade it. I'll let the data dictate. But what I'll do is I'll wait until let's say I've got enough sample size on to make changes. Then I would go and change it. I will see in 1 year. Yeah, all days were profitable in my back test. No worries about that. Yeah, exactly. So if your back test is saying that, you've got to trust in your back test, or else how can you put trust in your system? So yeah, in 1 year, maybe it depends. Like the way that I would change it is if it hits a max drawdown and it's clearly 1 day, that's when I would maybe change something or look at changing something. But when you're on that ongoing process, it's always good to look back and say, okay, what was the worst period on Monday, or what was the worst period Tuesday, Thursday, Friday? All those things can be individually looked at. That you can essentially build mini drawdowns within the system for each day. Again, that's getting a bit more kind of maybe taking it a little bit too far, but depends on how much drawdown in the system's in. These are all things that you can look at, and it's the good thing. Like I think that's the big bonus about having data at your hands and your fingertips is you can analyze everything. You can overanalyze things very easily as well. Like you can go down a mad rabbit hole in that. But yeah, for me personally, don't change anything, man, because this is looking good so far, and I'll add it to my favorites, and I'll be following this Darwin as it progresses, hopefully into gold in 2 months' time. So yeah, well done, man. This is great. This is great. 90,000. So you've got allocation of 90,000. We're looking. So you must be getting like another, you'll probably get another couple of allocations anyway. Do you know what is investors looking in Darwin's to invest, like 2-year min data or something? I would say like every investor is sort of different. So if you've got a group of your friends, right? Everyone's going to have different risk tolerances. Everyone's going to have their own like sort of like specifics. So I think like I'm trying to think of a good answer for this, because I think for me personally, like I invest in Darwins that have like low volatility with like returns that beat the S&P. That's my preference because I'm actively trading, but I like to invest in other people as well because more eyes is better than just two, in my opinion. And there's some really good traders out there. So I'm always actively looking at investing in Darwins. So for me, what I'm looking for is there a clear sign of martingale? If there is, I stay away from it. And that can be like seriously sharp drawdowns. Not to say that every martingale is bad. Like if you put it in a portfolio and really manage it well, like I've seen they can work, but again, it's a ticking time bomb as to how far are you going to let it go before you turn it off. So I would just say consistency to risk. If you look at, if we're looking at, the account signal management, you can see that your VAR is very consistent. The worst thing that I want to see is like a horseshoe sort of thing where it's, it started low, going up, and then coming down. For me, I'm not interested in that. Like, for me, it looks like you're really managing risk well because the VAR is low. Everything is low and very like squeezed. So it's, for me, this is what I would be personally looking for. Now, I can't speak for everyone else. I'm just speaking from my experience. And then when, if we go in my one, you'll see probably the exact same thing, and it will hopefully give like some similarities to. So my VAR has actually been coming down, but I've always managed it pretty well. Like, it's always been within that sort of squeeze. And see, every time that you see it drop, it's because I have deposited more money, because I don't use zero, I use classic. So every time that I make a big deposit into the account, the VAR drops, because the actual notional value is actually like a lot smaller. So my one's like getting lower and lower, and like I don't risk a lot. Like, every trade that I take is about 0.05 or 0.1%. So I always keep the risk low, and this allows, I think it's on here, my best days and worst days. Let's have a quick look. So similar to yourself, like, my best days, I've got a lot more best days than I do worst days in terms of returns. So, and this is all just because of like the risk sort of like management. I think my risk multiplier is 2.6 at the moment. But yeah, like, you'll see my drawdowns, it's like quite spiky, but that's because equity's moving. Where if you see like a straight line down, that's when I would be a bit more concerned. So like, even my max drawdown, like, it was up, down, up, down, up, down. It's like a really bad equity curve. But this is just what people have liked. And like, I started off when I first went into gold, like, this was like February 2024. I already had some sort of investment within 3-4 months. And as you can see, it's just steadily increased, and I've changed nothing. I've just kept that same approach, low risk, being consistent. This is a portfolio that has been building over time. So it started off with 20 strategies, and we moved to about 40 now, but I'm not like making any more. And then what I'm doing now is I'm actually building a second Darwin. So this is this one I'm going to show you is my test account. So this one is just the strategies that I'm currently testing that could potentially go into IME. And what I'll be doing is, the ones that are doing good is I'll potentially be rotating them in and out from ones that are not trading as good. So like, I've only ever removed 2 strategies. And the good thing about having a test account is you've constantly got things working in the background. Like, you kind of have your flagship sort of model, and then you have your like sort of like other one that I can then, it's clear that I've got strategies in here that are working really well, that I could then put into IME to create that diversification. So as long as the correlation is good, then I'd add them in. Like, for example, last month I was negative on this account in January, where in IME I was positive. So it's good to see like the sort of like, there's no like direct correlation between the two. But yeah, like, it's always good to kind of have that in mind. So definitely, if you can, you've got a good Darwin, create a second one, make it like a test account, because once you get to the point where you're starting to like get performance fees, it's good to kind of have that sort of like framework that you've got your main account, then you've got your sub account. So I'm just going to go through the comments now, because there's been a few. Would you recommend someone to make Darwin even if he does not have a proven edge? Difficult question. So I'm gonna relate this back to when I first started trading. I started trading with like £1,000 account. This was like 7 years ago, maybe, and I lost I lost about 50% of that at one point, and that was £500 gone. And I kept on depositing over the years. So I had 3 years of just straight up losing, where I probably lost £4,000 or £5,000 or something like that. Whereas if I'd done Darwinex at that same period, it would have been a lot cheaper, the losses. But also, I'd be learning like how to manage risk properly, because what Darwinex and the risk engine does do is teach you how to manage risk properly. How like, what is like an asset management firm? How are they managing risk compared to straight up like what you're told in retail? Now, I'm not going to have any digs at anyone that teaches anything, but there is some things that I feel like are taught that are not always the best to kind of follow. But everyone makes their own choices and what they believe in and all that. But yeah, I would say it is really good to probably like, not because I work at Darwinex and use it, but I'm trying to think back to when I was first starting and wasn't profitable. It would have saved me like a lot of money. It would have taught me better risk management, and you'd been on a platform where you get to see how others are doing. So when you first start trading, obviously most people come across those ads that, oh, I doubled my account this month, and so on and so on. There's so many of them out there that when you go to a platform like this, they're like, no one's really good. If you look at the top Darwins, like making maybe over 10, 20% a year, and in your head, you'll be like in disbelief that that's actually good. You're probably thinking, oh, but such and such online made 20% in a such and such in a small space time. These ones aren't doing good. But the people at the top of the Darwin leaderboards are managing real capital and actually doing well. So being exposed to that sort of side early on would probably have increased, it would have sped up my journey to get to where I am now. So I would say it's a really good platform to sort of use going forward. So zero and normal has different edge in this stats you show. Sorry, what do you mean by that? I'll start 5 months lifetime lol. Sorry, I don't get that. If you just explain what you mean, then yeah. Does anyone else want to put one of their Darwins in and we can go through a little bit of analysis? Or does anyone have any questions while I've been rambling on? So I'm going to, just while anyone puts something in, I'm actually going to digest this because I've actually never looked at the analytics of this account. With 5 months lifetime law, with respect, I mean, it's too early for conclusions. Sorry, Alessandro, what are you kind of targeting at? Go to the one with most investment. I think the index is the one that's got the most investment right now, but obviously that we can't digest and analyze. So yeah, this was obviously like the flagship. Tails. Finbo is the person that's behind it. I'm pretty sure they're an asset management firm that operate out of Switzerland as well. We can actually move on to something quite interesting with these guys because they're doing something else as well that I don't think people are aware of. So obviously, like this account here, like as much as it might, you put 3 last months, it's not trading that much. If you put 3 last months, it's not trading that much. Okay, I'll have a look. But yeah, so if we look at the results anyway, like last year was break even, year before was 4.14%. It's nothing groundbreaking, but it's still profitable at the end of the day. If we look at their past results, it's clearly they know what they're doing, but maybe right now they're going through a different patch, which all strategies can. I can show you algo trading strategies that I've developed that worked until 2023, and there's a specific strategy on GJ that I just got rid of because it's just been a straight drawdown, and these things can happen even to the best of us. I mean, for 800% return, last 3 months are not comparable. 800% return. No, this is since inception. This is like well over 10. This is from 2015. It's not 800% in the past 3 months. Past 6 months, it's down minus 3.68. Mario, if you just kind of explain sort of what you mean. SYO is still cruising. It's that man knows what he's doing, and I hope he continues to cruise. But we can't take anything away from THA. It's been a phenomenal Darwin, and I think they're just going through that kind of flat phase, which I'm sure that they might rectify, which is why we're going to go on to what they're doing right now. Is they've actually delved into algo trading themselves, it looks like, and have started getting something that's worked. So it'll be quite interesting to see how THA evolves, whether they start implementing algos as well. I don't know. I don't know anyone behind the team, but I just know that they've got another Darwin that's doing algo trade. So it could be quite interesting to see how this goes, because you can see that they've had a massive drop off in investment, but still right now managing 16 million, which is still no small portion. But if we go into their best and worst days, again, this is what you want to see long term. Your best days to be much bigger than your worst days. Even weeks has been pretty big, and months. So 11% months, quite a lot in the drawdown. We can move on to SYO after this as well. Assets can be interesting to have a look at. Yeah, so this is something that's very interesting here. So we can see on Mondays, is that 107 trades on Monday? So it's a lot of trades over a period of time, and it's quite clear that European session is their favorite, 331%, and then the rest is a lot of trades for, I would say, small returns. So this is maybe an area that I'd be kind of focusing on if I was them, but it is what it is. But Mondays for them are -8. So over such a long period of 10 years, I would definitely be diving into what is going on Monday. Probably the same with Tuesday as well. Like 18% over 10 years is a bit still profitable. I suppose it depends how many trades they're taking. Like, as I know, SYO is here from Spain and he has 40 bots on NAS 100. See, I don't know what he trades. Like, sounds quite bad. Like, as much as I'm part of Darwinex, I don't really know too much about other Darwins in terms of what they trade, because I've always kind of been focused on what I'm trading. Like, I can try and get rid of all the noise. Let me just go on my Darwinex actually, and we'll try get in and have a look at THA's other Darwin. Yeah, so this is their other Darwin at the moment. And this is their algo trading one, which, yeah, it's down this year, but they were up 16% last year and slightly up when they started. So it'll be quite interesting to see what they do with this Darwin. Like, it's already got like loads of investment, but will they start trying to pull some of the algorithms from here onto THA? Because that's obviously their main one that they've got investment on. So it'll be quite interesting to see the evolution of Finbo over the next sort of like year into how they're going to transition. So yeah, that'll be quite interesting from that point of view. Thanks for joining anyway, Mario. Great Darwin. Keep it up. So again, sorry, Kid Story Corner. Hello. I didn't realize that I've not been looking at the comments too much. Sorry. So I'll just go over the ones that I've got, the ones that I've not replied to. How many different EAs you start before opening a new Darwin? So my problem is, like, before I started trading on Darwinex, I already was like algo trading for 1 or 2 years prior. I can't remember the exact. So I already had about 50 systems ready. And what I did is I just put my best 20 into the first IME portfolio as it is. And I always trade the other ones in the background. It just depends on like what the returns of each algorithm are, the drawdown, and how they incorporate together in a portfolio as to whether is it ready to start a new Darwin. Because when you start a new Darwin, you want to make sure that like the risk is not too bad in terms of you don't want to have one algo that's risking 1% and then you add 6 algos and try and reduce the risk. Because as soon as you start doing that, it's probably not going to go, it's probably going to take like kind of 30 days for the VAR to adjust, roughly. So I think it's down to personal preference into what your goals are. But I always start with lower risk just because it's easier to add more without actually harming the account. So that's my personal opinion. But the account that I've got on the other one, I had originally 10 on this test account, and then I went to, it's about 35 at the moment on the test account. So between the two accounts, I've probably got about 60, 70 bots trading at the moment. So it is a bit of a minefield to keep an eye on or keep note of. But some of them are not like trading like every day. Like I've got my main systems that trade quite a lot. Then I've got my subsystems that maybe trade once or twice a month. And the whole purpose of having these smaller systems in that don't trade as much is their profit factor is their expected returns higher, but they don't trade as much, which is what you're probably going to find in a lot of algo trading systems that you build. The less it trades, if it exploits an edge, it's going to have a higher profit factor and like a higher sort of return to drawdown. Or not a higher return to drawdown in terms of total return to drawdown, but maybe average per year because it's not trading much. But my other ones, I've got some systems that trade like every day. So like that trade on dollar yen that I'm in right now, probably out maybe. That trades almost every day. And all I'm doing is, right this morning I was in long, and then we've seen a switch of momentum, and now I'm in short. So there is systems that I have that trade like every day, and they are all managed accordingly. KFK good as well. I'll have a look at KFK after SYO. Yes, 40 bucks is a lot, professional. Yeah, 40 bucks is a lot, but I don't mind it. I quite enjoy having a lot of trades. There's something about it. I love trading that much that, you know, I'm happier with having 40 bots on. You know, like they're all tested. They're all made sure that they're robust. There's so much tests that go into it to make sure that they're going to keep robust and keep performing, or we hope it keeps performing, because we cannot predict the future, can we? So yeah. Looking at SYO, like, yeah, some of the years are not above 10%, but I don't think people actually appreciate how hard it is to get like a track record this long and have every year profitable. Like that is like quite tough. Like everybody gets in their head, like even myself, like, oh, my tests are great, you know, my trading's great. I'm not going to go into a negative year or go into like worse drawdown than what I think. But I think I always have it in the back of my head that, you know, it will happen. If we read a lot of like top traders from the past, like some of them will experience some sort of drawdown. And it's what you do in the drawdowns, how you manage it, how you manage risk, what you're going to do to counter it. That is the, I think that's what will make or break a trader. Drawdowns are the toughest thing to handle. So the way that I handle is a risk load that I can make decisions. I don't have to make a decision overnight. I can take a week, a month to actually make an actual decision that's going to impact or change my portfolio. So that's why I like low risk, because I have more time to think, more time to react, rather than having to think on the spot like that. Like, okay, this system's not doing well. Okay, I've got this amount of open exposure I've got to cut, or we've got like this sort of event coming up. Do I want to be overexposed in NFP? So because I list row, I don't really need to worry too much about that. I only need to look at the metrics every month, make sure they align, make sure everything's taking trades as they are. That's just the way that I go about it. Thank you for answering. Most of my strats come from data mining service like strategy quant. Yeah, Kieran does a lot of strategy quant, and I do have strategy quant, and I'm still to dive into it. So maybe in future episodes, I will be going over some things with strategy quant, because it looks very powerful. Like I've got a list of Darwins that Kieran gave me from Juan, and it's just a list of Darwins that are all using strategy quant, and there are some very impressive portfolios on Darwinex that are using strategy quant. So it's very powerful. From what I got told, though, you need to kind of have that sort of robust framework, similar to how I do with FX Dream and Perfectus, that you're throwing everything at it to try and break it. So as much as I feel like I think unless you educate yourself from these software, they can be very dangerous as well, because as you're probably aware, it will give you 1,000 tests within the hour, and it'll show profit, profit, profit. But again, it could be completely optimized to the market conditions, because it is like as you say, it's data mining. It's just like it's learning from the data to then create that strategy. It can create those perfect back tests. The way to do it is kind of like shake it. So change the parameters. Like if you're using like Bollinger Band, okay, let's change the period as well as like the sort of like standard deviation. How well does it handle if we change the standard deviation by like say small amounts, or how much does it handle when we change it by big amounts? Obviously, if you go from like a 3 to a 1 standard deviation, you're going to see massive difference in results. It's more like if we put it up by 0.1, 0.2, 0.3, 0.4, where does it start to lose its edge? At what point does it start to break, start to fail? So these are things that like I like to throw at it, so then we can actually see where it fails. And going into like further, like this is more like advanced when you get to the stages, when every month, or like I don't do it every month because every month's a bit, you might not have enough trades, but every 3 months I will then re-download my data to update my feeds so that it's got the latest data, retest and redo these tests, because we might see that it's safe working between a standard deviation of 1 and 1.8. But over the past 3 months, it's squeezed to like between, so let's say 1.1 and 1.3. So 1.2 is what you've maybe picked, but it's squeezed into that area. So it'd be interesting to see, does it continue to squeeze or does it expand? Because sometimes you might like these are like how robust. This is how I do robustness. Like literally, it's like a spring trying to compress it and see, does it work within a bigger range? And I pick somewhere in the middle that's giving me like not the best results, but let's say the best result was 10,000, but I've got like near it's like 8,002, 8,001, 8,002, 8,003. I pick somewhere in the middle of that because either side the results are pretty much identical. So even having that sort of like added space is still getting about the same results. But yeah, that's what I believe. I'm speaking from purely things that I've been told because I have it, but I've not used it yet. So could be interesting because we could be having conversations in like 6 months' time, and I have like fully engrossed myself in strategy quant. Yeah, sorry, rambling on there. Let's have a quick look at the market to sort of see my losing positions, of course. Also in like Aussie yen long, so that's seeming to be this could be a long trade. Like Aussie yen sometimes like it's explosive and then it like goes through that sideways thing. So the good thing is in long we're picking up the positive swaps, but like that's it's not going to make too much difference to the account. We can see silver starting to slow down. Be interested to see like if we kind of get like, where's my paintbrush? If we kind of get like this kind of like slow, and then we'll see how it reacts around that sort of 70 level. Has it reacted off 70? No, it's not quite 70. But it'd be interesting to see like how it reacts off of that 70 level, because whole numbers and areas are where people kind of look for support resistance if it lines up with things. I'm not an expert at manual trading. I used to do manual trading in terms of like I used to like do swing trading, so I'd look for reversals, but that was more on like the obvious ones like Aussie CAD, Aussie New Zealand, Aussie Swiss, things like that. So that was my background before I got into algo trading, and I'm just purely breakouts now, to be honest. So I really need to diversify back into some mean reversions, but I think there's like, what I say to Kieran is like, I don't really need to change from breakouts because breakouts will always happen because the market always needs to move. I suppose the same can be said for like mean reversion, but breakouts are always going to happen on certain assets. and they historically have. Like, if you go back and read books from like 80s, 90s, the same things that moved a lot then are moving right now as well. Not as big, but they're still the more volatile pairs that trend following worked on. So there's a little thing to go away with. Like, try and do some research on like some traders from like 80s and 90s. See what assets they traded from a trend following perspective, because you'd be surprised into. Obviously, they're not going to be the same in terms of like assets. So like they might just be trading the euro, they might just be trading like the pound, or they might be trading the dollar. Or just like the yen. So like, you know, that's the sort of things that they traded. Like, rather, it didn't say like USD, Japanese yen. You know, everything, if you're looking at an American market, everything was against dollar anyway. So yeah, you'll find that yen pairs 20, 30, 40 years ago all trended. So, you know, if you're looking to build trend following or breakout systems, definitely look at the yen pairs. I mean, it doesn't maybe look too good on the daily right now, but if you look at 2020 was one of my best years for trading on dollar yen, and you can see why. Like, it was so trendy in that year. Like, we've not seen something like that since 2012. But there is points where this thing trends hard, and you know, that was like what gold is another one that I trade, like, because it is crazy to look at like what's going on right now. Like, it's trending hard. My problem is because I risk so low, I'm getting squeezed out of minimum lot sizing on, I think it's like £40,000 or something like that. So, like, yeah, I'm struggling to trade gold at the moment because I trade one of my strategies has ATR stop loss, and it's really struggling. Yeah, I actually forgot to go over KFK. Let's have a look over KFK and analyze that. I know this has been an analysis session, but I've not really went over too much analysis. I've just kind of bored you guys to death with just information on my beliefs and things like that. KFK. Okay. I mean, it's profitable. That's what I would say. It's profitable at the end of the day. It went through that terrible period here, but then, is it terrible? No, it's just kind of sideways. Like, if this was a singular strategy, I would be surprised if this was a singular strategy, which to me is like, it's gonna happen if it's like mechanical rules or step-by-step rules. There's gonna be periods, like, it's very hard to get strategies that work all the time. So maybe it's not a singular strategy, maybe it's multi-strat, but again, it might be algo trading, it might be manual. I can't really tell at the moment. But just from this, we can see that Thursday is the thing that's killing it. So if you took away Thursday, this return would be like 18%, probably with a lower drawdown here. So excluding Thursday could have been good. But again, it's not enough trades. For me, it's not enough trades to make an actual judgment decision, because it's just not enough trades. Like, how many trades is this account taking? Don't tell me this is my internet going down. Yeah, just so everyone's aware, like, my internet over the past couple of days has been terrible. I've had power cuts because unfortunately I live in the north of Scotland, which it's winter, so it's inches of snow last month, and now it's just been pure rain for about 20, 30 days. So everyone's struggling here. Number of trades. This is what I was looking for. No, this one. Yeah, 112 trades. I would not make a judgment on 112 trades whether to trade to get rid of a day. Like, we need to be looking at bigger sort of like people that have been trading for a long time to really make a decision on. So let's just take SUG for an example. We can have a look at the days, because this is a longer track record, really good. So we got 15,000 trades. Now we can actually make an assumption, and every day is really good, bar Wednesday still positive. But what's interesting is Wednesday is this one, so we can see that it's just been pure drawdown until whenever this point was. So either he has looked at Wednesday and thought, okay, something's not working here. He's maybe changed something, because now it's looking not too bad. So this is what I mean by like he's had enough. Like if he has done this, he's got some significant amount of data to say Wednesday's just not performing at all. And if it's a breakout, I think it'll just be because it's turnaround day Wednesday. So certain assets like dollar yen, I don't think works well on a Wednesday. In certain strategies, if it's taking daily highs or like a breakout of a daily high. So if he was taking breakouts of daily highs on certain pairs, like this might not work so well. But yeah, obviously something's changed, or it's just this is just what's naturally happened. But from it going like this to sort of like from here to quite a nice looking healthy curve, I would probably say he's changed a few things to enhance the portfolio, because now it's in the positive. But yeah, something like that is significant data, and that's why we backtest. That's why we look at these things. So then we get significant data to make good decisions to make firm judgment on. GKE as well. Again, this is healthy. Yes, there's certain periods that are really underperforming, but take away Monday, everything is pretty close. So this is what you want to see. You want to see like everyday profitable from an algorithmic, because I know this guy, Wim, I think his name's Wim. He's an algo trader as well. So he would have made, maybe he's got data all the way back to God knows how long, been trading for a long time. So he's got the data to make judgment decisions. So this is what I mean, like volume of trades speaks a story, where making like changes to 100 trades for me personally just wouldn't hold as much weight. So this, it's another reason I'll always go back. You'll always see like a default with me. Like I'll always go back to this is why I risk low, because you know it allows me to have say 100 trades at 0.1 is only like a 10% loss. So I would need to lose 100 trades in order to lose 10%. It's not going to do that in a row. It might over like a sequence of years, and like maybe a couple of years, 2-3 years. So, but I would be able to identify that well before the AV gets close to that. So if the max drawdown in one of my systems is 1.5%, and on a singular like day like Wednesday, it's down that 1.5%, but the rest of the days are up, I already know that like it's went past its max drawdown and it's all happened in one day, so that I could make a good judgment decision. For the most part, unless it happened like 15 trades in a row. That again, it wouldn't be enough data. But I would then go look back at singular days, like what was the max drawdown in the singular day. If all the other days are profitable, if it was like 2, then I know it's still within its drawdown for that singular day. But it would have exceeded its max drawdown, which I do have a buffer for max drawdown. So if my system was like 1.5% drawdown, like I would run a Monte Carlo test. I think we can do that like this anyway. Let me see if I can bring them up. Don't know if that can be seen. Let me just double check. Yeah. So how can I zoom in on this? Can I zoom in on this? Maybe not. So yeah, we're gonna choose. Let's choose this system and let's do Monte Carlo analysis. We're not going to run 1,000 simulations because I'll probably crash the stream. Yeah, so like the original max drawdown, sorry, was 1.21%, and with a 95% confidence rating, the max drawdown is 1.7%. So, you know, that's, what's that? Just a little under a 50% variable. So that for me, like I would say 1.7-ish is about where I would turn the system off. Or what I would do is maybe half the risk if everything else is looking good. it could just be a new max drawdown. But if I did risk it to the half, then I'd only push it to the 1.95%. Then I'd turn it off or put it in my second sort of like portfolio. So that's the sort of thing that I would do. And then this gives you like a good indication as to like how different the levels can be as well. So as much as you do a back test that says 1.5% profit factor, 1.2% drawdown, 9% return, you're not going to get I say not. You could get an identical result, but for the most part, you know, if you're around 100, if you've done 100 times, you know, you're not going to get the same result. So this is why like having a robust number that's equal to like, so if I've got like, if I was on the system, I think it's a 4-hour ATR, the 3-hour ATR and the 5, 6 hour, 3 hour all work. I know I've picked somewhere in the middle that works, that's all roughly the same sort of profit area. I can expect this sort of thing in you know, going forward, because it's went through my robustness tests and I can expect something along this line. This is what I mean by like, so if we look at the worst sort of case here, like it went into pure drawdown straight away and then exploded. So I think that one actually ends out somewhere around here anyway. So actually higher than expected in total returns, but the initial drawdown was higher. Initial losing streak was higher. And this is why I would turn a system off straight away, because you can see the system totally turn around sometimes. So that's why, like, let's say we get to the max drawdown in terms of confidence rating, I would then half the risk. And then if it does push to like new equity lows past the 100% confidence rating, I would then turn it off on that portfolio, put it to something that I'm happy to risk money on. So like if you have a test account in Darwinex 0, for example, I would put it on that. And then we can analyze, is this a new equity low drawdown? How long does it take to get past the equity high? So looking at stagnation period, because like they're the two metrics that I look at: stagnation period of the strategy, max drawdown. It might not go in max drawdown the whole time, but if it's more than the stagnation period of what it was previously, I would then got to ask questions: is this just churning away and costing me commissions and swaps? It's another area to look at. Like, it's not always about, is it reaching max drawdown? If the system is literally moving in a line, break even, it's not doing anything for you apart from adding extra costs for no sort of return. So that's another thing that I would look at. So between max drawdown, stagnation period, again, I would apply a buffer to the stagnation period. Like if the stagnation period was 40 days, I'm not going to put 40 days on it. But if we look at what the stagnation period of this is, 616 days. So that's a long time that's in drawdown. And we can actually see it is only just actually come out its stagnation period. So before, stagnation period would have been like, I don't know, 40, 50, 60 days, maybe prior, where it's now took 600 odd days. So this is concerning. This would be concerning, because if you made this back test till April 2024, it was perfect. You turn it on, it goes straight down. But this is what I was on about in the Monte Carlo. Sometimes that'll happen, and then it absolutely blitzes and makes new equity high. So this is a new equity low of 1.2%, and it's a new stagnation high. But it has exceeded it's now exceeded that. So clearly the edge is not dead. It just went through that period of stagnation. But if I was to risk 1% on this, this would have been a lot of profits gone. Or like you would have noticed it. You would have noticed, like, if this was, so this is your 0.1 risk, so 1.2 commission. So 10 won't be 10 because of compounding. So let's say even on a 1% risk scale, this might be between 15 and 20%. On a Monte Carlo scale, that could be near 30%. So this could have been a 30% drawdown risk in 1%. You're going to notice that where 1.2%, I'm not noticing that at all. Like, and I've got, like, if you look at from here to here, that must be like 400 or 500 days to go down just about 1%. So this is why, you know, I'm very big on keeping with risk low, because it allows me to either allow these strategies to play out, you know, allow them to play out, allow them to make new equity lows. And then, you know, for this one, it's obviously making new equity highs. So this is a system that I would potentially be looking to apply to IME if if the correlation between other strategies on GJ are looking good. So that's another one. This is another one that I made today. Again, this is using, surprisingly, people say indicators don't work. This is using RSI, such a basic indicator, and it looks pretty good. There's a bit of work to be done on it. Like this is in its raw sort of state. So short. Okay, this is interesting. Sorry, I'm going to cut this bit out, but cut that out. Sorry, and I'm going to go into this. Sorry. We can see that Friday's negative, Monday's terrible. Look how big that edge is on Thursday. Like that is crazy. Most of the return is from Thursday. Monday not, Friday not. So again, we have got 918 trades on this system, and we're averagely taking 100 a year. So I would say from this, we can make a good calculated decision that we're not going to use Friday. So let's take away Friday, take away that because it goes so long and short. Let's include this and let's analyze it. Okay, so we've lowered the drawdown, we've increased the win rate, we've cut the trades by 150. Yeah, so that's quite over 150 trades we've cut out. It's decreased drawdown, increased returns. Let's have a look at the analysis now. Nope, wrong one. Is it? Yeah, here we go. So just get rid of Friday. We're now at that area where it is now looking good for me to potentially add to the portfolio or add on the test account because we're now drawdown is almost equal to average return per year. This is what I want to see. So again, stagnation period's a bit high, but again, this is why I love portfolios because you could have 100 of these systems, right? And the stagnation period will be totally different in them all. As long as they're on different assets, different time frames, entries, you will find that it will smooth this curve out massively. So what can be quite interesting to do is let's add our what if systems together and see. So the max stagnation of this one's 532. The max stagnation of the other one was 600 and about 408 after we make the changes. So let's see if we can get it more than 400. Yeah, look, we have massively. So if we went from 408 max stagnation in one period to now combine them, we're at 256. Yeah. So now we're combining them both. Like I know the returns are you get more interest in the bank than this portfolio, but this is only two systems together. This is why you add another 10 more, and that's 14% a year, 9% a year, 12% a year, 24% a year, 30% a year, and drawdown will be probably about 4. I reckon if you got 10 more of these, 20 more of these systems. But yeah, we've now decreased the stagnation period. The stagnation period is now, if we were to look at just sub-equities only, stagnation period is here, but what we can see with this system is when this goes into stagnation, this is still performing. When this is in stagnation here, the other system's still performing. And you would expect, because it's both trading on yen pairs, the correlation would be quite high. But this goes to show that even trading something that's very similar in terms of correlation, it still works pretty well. Where is the correlation? My bad. My bad. So on the day, it's not too. So on the day, it's got literally no correlation whatsoever. On the week, small, and on the month, very small. So these two systems, as much as they both trade yen pairs, are almost uncorrelated completely. There will be some correlations in entries, depending on, like, let's say, like the yen is collapsing. Pound's going to be going up, and so is the dollar. There might be times where these cross each other, and they will be in positions together. But that's where the small correlation comes in. So most of the time, This one trades on the 4 hour and the other one trades on the daily. So they're completely different entries, completely different criterias. Everything's different. The only thing that's the same is they're both trading against the yen. But yeah, once you add in like loads of these, so let me actually, let me just like add in a few more systems. So I'll add in the ones that I've been making this week. So that's 2, and that's this is the first time that I've done optimization on those 2. So if we're looking at the optimization there, let's do this. It's one of my new systems as well. I believe it's this one as well. So these are the systems that I have made this week. Yep. And we can analyze these ones as well, just quickly. So Tuesday, not a good day, which is cool because on the other UJ, Tuesday was good. This Tuesday's terrible, but this Friday's good. So we'd get rid of this on the Tuesday. Because 611 trades, there is a significant amount of trades to say we're not trading Tuesday. Okay, so now profit factors above, drawdown is seriously reduced. So 0.33 max drawdown to 3% return. How is that looking from return to drawdown? Yeah, so again, there's more return per year than drawdown. This is exactly what I'm looking for. Again, stagnation period's quite high. This is why I say, like, I don't really care too much about stagnation period too much. As long as you're like combining them together. Okay, so I'm happy with that. Now, NASDAQ, this one's already like the exact same drawdown to return. But let's see if we can see anything. Short side not working. Okay, so we'll get rid of shorts because over 104 trades. Yeah, we're not winning. We've had 2 positive years. So direction long. And then analyze. Every month profitable. Interesting. September, October, February not so good. But this is what's interesting, right? So spikes are, so this is GMT plus 2. So 10 o'clock's actually 8. 4 o'clock's actually the hour between 2 and 3. So 2 and 3 is when New York opens, massive spike. So this strategy's got loads of edge when New York opens. 10 again, London opens. So that's 8 in the morning. This has an edge. 1, 2 in the morning is midnight, which is when sort of late. Asia second, Tokyo opens, massive surge. So this system has a massive urge when markets open. And then taking the short side out, we've got 0.47 drawdown, 0.54 return. These systems all 100Ks. Yeah, cool. So now let's see what happens when we add 4 systems together. Is it working? Yeah. So ignore 2016. So that would actually probably be a lot higher returns because it's including the no years in 2026, not 2016, 2026. So now we've reduced the stagnation period to 193 days just by adding 2 more systems. Let's go to long and short. We've not got many shorts because we already got rid of longs, and one of them was a long way strategy. But what's really cool to see is between the hours of 8 and 10, which is your end of day, there is no profits to be made there. So we'd probably just get rid of that because we've now got 2,069 trades to say, yeah, let's just ignore that, which makes sense because it's end of day. But what's good to see is Monday, Tuesday, Wednesday, Thursday, Friday, all sort of profitable. Thursday clearly has massive edge with these 4 strategies. Wednesday's looking good, Tuesday's looking decent, Monday's looking decent, Friday's looking decent. Alongside, I'll say massive against short. If we look at the equity curve now, again, we've added 4 strategies. This is starting to look like something good. This is starting to look like something we're going to add to the portfolio, potentially, these 4 strategies. They'll probably go to the test account first before they go on to IME Live, but yeah, we're looking good. Another thing, I went over it yesterday for anyone that was on yesterday as well. It's very good to look at the listed trades when you're on Quant Analyzer, mainly because like it'd be interesting to see like how your profit and losses are against everything. So don't know why some of these are actually. It's because I put it in portfolio format. Yeah, so not in a portfolio. Don't look at this in a portfolio. Look at this in a singular strategy. Yeah, why is that coming up like that? I need to look into that. But yeah, on this strategy, you can see there's about 0.1% risk per trade. It has a trailing stop loss, so the losses, the straight up losses will always be 0.1, roughly about that area. You can see this one, 0.17, lasted 52 seconds. So this is where you can expect, this is why when you're trading around news, like this is probably around a news event or low liquidity, I've been slipped almost 100% of like the risk. So like about 70% technically. So yeah, again, it's why I risk low, because if that was 1%, I'd have lost maybe 1.7%. So an extra 0.7%, that can hurt you in a portfolio state, or like, you know, if you're risking a lot higher. So this is why it's interesting to have a look at these sort of trades. When you like test on real tick data as well, and you've got lower time frame, like smaller stop losses, you'll see a massive impact in this. Because if you're trading around news events and you've got 10 pip stop loss and price moves 100 pips, you might get cooked. That's basically all I'll say. So it's very good to kind of analyze these things and see how often you're getting slipped. Is there any point where risk kind of goes crazy? Because there might be a day. It's happened to me. I think it actually happened last week. So you know, Bank of Japan intervened and things just plummeted. If I got it up on this. Yeah, so let's go to this event here. So I think I was like in the breakout somewhere like here. My stop loss was like under here. So everything was looking good, was about 1% in profit, or you know, 1 hour in profit roughly. And then Bank of Japan intervened and that nasty candle, right? So stop loss was here. Instead of me getting out here, I got slipped out about here, roughly, somewhere like almost like double. And this can happen. And this is, again, this is why I risk low. So I have an account that's spread betting that I risk a lot more. I lost quite a lot on this trade because of the slippage, because there was no liquidity, there was nothing. I couldn't get out of the situation in terms of like at the price that I wanted. But on my main portfolio, IME, it didn't matter too much. I think we can actually see, if we go here, if we actually look at singular weeks or days, candlestick wise, was it the second? No, 23rd. Maybe I can't go back. Zoom out. Let's go to the month. Yeah, there we go. See? So 23rd was up a little bit. You know, we can see we're almost making new equity highs. And then this happened. And within the whole, like, must have been 5 minutes, I went from being up probably about 0.3% to down 1.7. That's mainly because of the risk adjustment, obviously, like it's ×3. So I wasn't just in one trade. I think I was in 3 or 4. And I got slipped hard because this is why the loss was that big. So yeah, this is a reason why I risk low. So like things like this, like a big flash, like a big drop off, I'm not getting killed. It's not like if we look at like the, you know, even if we look across the 3 months, not 3 months, probably not a good one. If we look at the line as such, like even the line, like you wouldn't really notice like these big dips. Whereas like I don't know. I don't really have a Darwin that I can use as an example. You'll notice like the big dips in drawdown. So I think it was here. Yeah. If we see like we're making new equity highs, drawdown literally went from 0.39 to 2.8 within like 5 minutes. So yeah, and that's even with low risk. Like I think the good thing is like because the VAR system's there, like it really does protect you in that sort of stage. Anyway, I've been rambling on for a long time. Does anyone have any questions? And I'll probably just call it a day there because that's about an hour and 20 minutes I've been on here. Anyone have any questions about anything that I've been speaking about, or anyone want to go over anything? Anyone got Darwin they want me to look over? I'll just give it a minute. Okay. Well, if no one has any questions, then I'm going to call it a day. Thanks for joining me tonight. This has obviously been my second one on my own. I hope you've enjoyed it. If you have any questions for me, obviously, you can always join the Discord, drop me a message, or find me, or get in touch if you want to ask me anything. I'm always open for a conversation. I'm always open to learning new things as well. You know, we're all learning at the same time. Some of us are at different stages than others, but always learning. But thank you for joining, everyone, and have a good rest of the evening.